Hi everyone, it's Stephen here. The Bank of England have just increased their interest rates for the 7th time in a row, increasing it by 0.5%. This is the highest the interest rate's been for 14 years. It's gone up from 1.75% to 2.25%. So that's why it's important to cover what they say is going to be happening over the next year, what's the biggest changes that are being made, and how this is going to impact you, and most importantly, how you can benefit from this information to take control of your money. So one of the key reasons why the Bank of England monetary policy exists is to control inflation. Inflation is a measure of how much prices of everyday items like food, petrol, haircuts have gone up over a period of time. It's measured by how much things cost today and then compared to how much they cost a year ago to get an inflation rate percentage. So inflation right now is 9.9%. So that means on average, everything's gone up 9.9% over the last 12 months. The target rate for inflation is 2%. So what this means is that the Bank of England monetary policy needs to keep within the tolerance of 2%. They're allowed to go either side of that by 1%. One of the other factors that the Bank of England have up their sleeve, other than just changing the interest rate, is that they've done quantitative easing. So what this means is that they're able to go and buy government bonds which stimulate the economies. Buying these bonds is giving the companies more money so that they can then spend that money on investing in other things like stocks and shares. But this quantitative easing policy has come to an end in December 2021. When the Bank of England changes the bank rate, they do this by looking at the cost of prices on a month-by-month basis and also on a year-by-year basis, and look forward to say how much things could change in the coming year, and that will dictate how they change their monetary policy. So higher interest rates means that people spend less money and they borrow less money, and therefore the economy starts to slow down, and by it slowing down, companies no longer put their prices up because people are less likely to spend their money. The biggest reason the bank has increased the interest rate is to fight inflation. With inflation now at a 40-year high, and unfortunately inflation is driven by many factors outside of their control. Things like the war in Ukraine, the rising cost of oil and gas, food prices being at a 14-year high, all of these impact inflation. When the bank rate increases, the banks pass this through to the mortgage interest rates, and this has the impact of reducing all of the household's consumer spending power. So what does that mean for the next 12 months? Well, the plan now is to offload £80 billion worth of government bonds over the next 12 months. With the introduction of the energy price guarantee by the government, they're expecting that the inflation will still increase a little bit over the next coming months, but will peak in October and hit around 11% before it starts to fall back. Demand for labour has been slowing down. GDP has also been slowing down in Q2, and they anticipate GDP growth will also slow down in Q3. Construction's decreased for the second month in a row in July. So that's June and July where it's decreased, but previously to that it'd been increasing for 7 months in a row. We're also seeing some easing in supply chains with costs coming down on both air and sea freight now as we come and sort out the blockages that have been caused from the pandemic. Retail sales trends decreased in August, which is a trend that they've been seeing since mid-2021. And we've also seen the housing market start to tail off in June and July, but house prices are still remaining strong. So how's this going to affect you? Well, the Bank of England is still going to fight inflation, and their aim is to get that target rate of inflation down to 2%. How long is that going to take? Well, no one really knows, but they're saying that they're going to fight it with a full force if they have to. They're trying to strike a balance between the inflation and the economy so that they can try and get the inflation to their target rate, but also keep the economy growing. Rates are expected to rise again towards the end of the year, probably in November and December, with an overall rate by the end of the year potentially at 3%. The government's going to be releasing a mini budget which is likely to have tax cuts inside it, which is going to help everyone out when we're coming to higher interest rates and the high inflation that we're all experiencing. So what you should be doing is having an emergency fund set aside, and this should be about 4 to 6 months worth of your expenses. You can also be now putting some money away as savings because interest rates are going up, your savings rates are going to be up. The highest savings rate that I could find was this one from NatWest at 5.12%, which if you're a regular saver, you can get access to this and still get instant access to your account. If you've been investing, keep investing in those that you plan to keep for the long term, because the pound cost average is going to even itself out over the time. So whether the market's going up or down, if you keep investing that same amount every month, for example, you're going to be evening out how much those shares are going to be costing you. Thanks so much for watching. I really do appreciate it, and I'll see you next time.